Hi, I'm Kara Murphy, and this is Money with Murphy. Last week was one of the busiest weeks for markets all year, and I'm not even talking about the election. So just in case you've been more focused on politics than markets, here's a wrap on what you may have missed and what's next. First, let's look at earnings. Last week, about 1/3 of companies in the S&P 500 reporting their earnings for the third quarter. Collectively, those companies represented nearly half the S&P's market value. Of those firms that have reported, 3/4 have beat estimates, which is actually a bit lower than historical average. Included in those reports were 5 of what's become known as the Magnificent Seven companies. Collectively, the Mag 7 were expected to grow earnings by about 18% this quarter compared to last year, an impressive rate after posting gangbuster earnings growth for much of the past 2 years. Despite reporting impressive revenue and earnings growth, Mag 7 stocks as a whole slid on the news, demonstrating how difficult it can be to impress a market with already high expectations. In addition to company earnings, numerous pieces of economic data were released last week, giving us more information, though not necessarily more clarity. Arguably, the most important of these data points was related to the labor market. Now, keep in mind that over the last few months, although job growth has slowed, jobs have remained relatively plentiful compared to history. In October, though, that picture changed. The number of private payrolls last month actually fell by 28,000, marking the first decline in nearly 4 years. Now, that report comes with important asterisks in that several events may have temporarily skewed the data, from hurricanes in the southeast to strikes at Boeing. As the jobs picture grew bleaker, so too did manufacturing. The Institute of Supply Management's Manufacturing Index survey dropped from an already low 47.2 to an even lower 46.5. Companies in the survey reported rising input costs, a red flag for the Fed, along with declining new orders and backlogs, signaling weak demand. Both exports and imports dipped, suggesting the manufacturing slowdown is not just a domestic issue. The stock market had to digest these disparate data points from earnings, labor, and manufacturing, and ended the week down slightly. Meanwhile, Treasury bond yields rose, continuing their upward trajectory that began, ironically, with the Fed's last rate cut in September. While most Americans will be watching the vote tallies come in, it'll be the Federal Reserve's job to weigh these sometimes conflicting signals when they meet again on Thursday and continue that careful balance of slowing inflation and yet supporting growth. Until next time, invest wisely and live richly.